Is Pfizer, ticker symbol PFE, a good stock to buy now? Welcome to Global Value. In today's video, we're performing a fundamental analysis of Pfizer using Warren Buffett's investing framework. We'll look at 6 key financial metrics before we figure out 3 different fair values to understand what Pfizer is worth in today's stock market. Plus, I'll share a special bonus that could be the deciding factor when adding Pfizer stock to your portfolio. Right now, Pfizer trades for $27.99 per share. In its most recent day of trading, it's down 1.31% alone. Pfizer is just $2 above their 52-week lows, which are down more than $10 from their 52-week high. Since June of 2023, Pfizer stock is down 22%. This comes as the S&P 500 is up 26% at the same time. Going back 5 years to before the pandemic, Pfizer is down 34% overall. In the last decade, they're down 6.6%. And when we go back before the global financial crisis, Pfizer stock is actually flat. They're down less than 1%. Thankfully, these aren't the only returns for shareholders. Right now, Pfizer pays a huge market-beating 5.85% dividend yield. Their dividends are added back to their gains in this time. Starting with metric number 1, we want their average return on capital to be more than 14%. Returns on capital tell us how much value the company is creating. Think of it like your form when you're lifting weights. You want great form before you add more weight through growth. In this time, we really see the boost in profits from their vaccine boom in 2021 and 2022. Then in 2023, for reasons we'll discuss, these returns fell off a cliff. Their returns probably won't be as good as these boom years, but they're likely not as low as they were in 2023 on a more normalized basis. Still, when they're averaged out, Pfizer earns exactly 14% returns on capital, which is exactly what we wanted. This is our first check of the day on metric number 1. Now, what does the company really do? Pfizer is one of the world's largest pharmaceutical firms with annual sales close to $50 billion. That's even excluding their COVID-19 product sales. While it historically sold many types of healthcare products and chemicals, now prescription drugs and vaccines account for the majority of sales. Top sellers include pneumococcal vaccine Prevnar 13, cancer drug Imbrance, and cardiovascular treatment Eliquis. Pfizer sells these products globally, with international sales representing close to 50% of their total. Within international sales, emerging markets are a major contributor. Pfizer saw a huge jump in their sales related to their COVID-19 vaccine. Since then, they've been on an acquisition spree. They acquired Trillium Therapeutics for $2.3 billion in August of 2021. Then, in March of 2022, they acquired Arena Pharmaceuticals for $6.7 billion in cash. After that, they followed up with Biohaven Pharma in October of 2022 for $11.6 billion, and Global Blood Therapeutics for $5.4 billion. Then came the huge acquisition for Pfizer. In December of 2023, they acquired Seagen. Seagen is a pioneer for antibody-drug conjugates for cancer treatment, and Pfizer paid $43 billion for the company. Through those acquisitions, they've used all of their COVID profits. In our second metric, we want growth in their sales, earnings, and free cash flows. Because they had these high returns, they can create even more shareholder value through growth. In the last 5 years, their sales have grown 34% from $40 billion in 2019 to nearly $58.5 billion in 2023. They more than doubled year over year from 2020 until 2021, and then they almost fell by half from 2022 to 2023. Clearly a boom. That's also the case when we look at their earnings and their free cash flows, as these have both come back down to earth. Again, though, this is concerning because their earnings and their cash flows aren't even at the levels they were pre-COVID. Their earnings were down 80% from 2019 until 2023, and their cash flows dropped by more than 50%, even with their big acquisitions. In their last 12 months, their earnings were actually negative, and this comes from major asset write-downs and merger and restructuring costs in 2023 and so far in 2024. It's an X on metric number 2 for Pfizer. Today, Pfizer is owned by 6 super investors, with 4 of them investing in the first quarter of 2024. This is led by Kahn Brothers Group, who has a 4.21% position in the company, but they recently trimmed just a very small amount of their shares. Next, we want to look at the company like an individual shareholder. In metric number 3, we want earnings per share growth. Unfortunately, this isn't the case for the business. Their earnings peaked in 2022 and fell off a cliff in 2023. Again, these are negative today. At the same time, Pfizer has kept shares around flat, meaning their earnings per share are negative. It's an X on our third metric. Metric number 4 is similar but even more important. Here we want free cash flow per share growth. Cash flows are really the lifeblood of any business. And in this last 5 years, we learned they're down 50%. With similar amounts of shares, their cash flows per share are also down at this rate. It's another X on metric number 4. So far, Pfizer's only one of 4 on our analysis. Before we look at the company's balance sheet, it's time for our first bonus. Right now, Pfizer pays a huge market-beating 5.85% dividend yield. But is this safe? That's what we're trying to figure out through our bonus, where we want their dividends to be covered by their cash flows. Pfizer covered these in 4 of the last 5 years, but 2023 was an exception. These were easily supported until then, but today Pfizer pays out more than double in dividends than what they bring in cash flows. Historically, Pfizer has been a dividend growth stock. They've grown their dividends for each of the last 13 years, and while they didn't support these in the last year, they still grew them by 2.47%. Unfortunately, that's not what we wanted to see, as we need the company to be able to cover their dividends to shareholders. It's robbing Peter to pay Paul if a company can't fund what it's giving back to shareholders. This is an X on our dividend bonus. Now let's look at the company's balance sheet. Now, in recessions, it's companies with too much debt that can have the biggest losses and even go broke. In metric number 5, we want their net debt to be covered by the sum of their free cash flows. Pfizer has used pretty reasonable amounts of debt in most of these years. They were at $43.5 billion before the pandemic, and because of their high amounts of cash flows, these dropped to as low as $10 billion in 2021. Then with their acquisition spree and their big Seagen acquisition in 2023, the company both added more long-term debt and they reduced their cash equivalents. Pfizer's been paying this down somewhat in 2024, and today the company has $58 billion of net debt. In the last 5 years, with their boom period, they brought in $83 billion of cash flows. That's supported, but you want to figure out what the company is going to produce in an average year. So far, they haven't returned to these pre-pandemic numbers, so that may be a concern for shareholders. Still, they do support their debt loads, and it's a check on metric number 5. Now it's time for our safety bonus before we figure out how much Pfizer is worth. Ben Graham, the father of value investing and Warren Buffett's teacher, wanted to see a current ratio greater than 1.5 times. This is a key measure of short-term liquidity for how a company can pay its bills in a hurry. It's its total current assets divided by its total current liabilities. Pfizer ended 2023 with this ratio below 1, which can be an issue for some companies. They haven't been at the 1.5 times mark in any of these years, and they're just slightly over 1 today. This means it's an X on our safety bonus. This may not be as much of a concern for a company like Pfizer, but it's still something to pay attention to, and it's less than ideal. Now, the big metric of them all, metric number 6, is also today's first valuation. We want Pfizer's average cash flows divided by their enterprise value to give us a yield above 5%. If this is the case, it's in line with the historic yield from the S&P 500, and it gives a risk premium to the 10-year Treasury. Today, Pfizer has a $219 billion enterprise value, which looks at the company like it's a private business by adding their market cap and their net debt together. In an average year over this time, they brought in $16.6 billion of cash flow. When that's divided by their enterprise value, it gives us a 7.7% average cash flow yield. In their last 3 years, they brought in around $10 billion on average, which gives us a 4.7% yield, and in their last 12 months, they only brought in $5.1 billion. That's only a 2.4% current yield. They're above the historical yield we wanted, so it's a check on metric number 6, but it may be a very concerning sign for shareholders that they've made all these big acquisitions and they haven't seen cash flows from it yet. Keep watching our next 2 valuations before you stay till the end for Pfizer's final fair value and rating. Next, we'll use a DCF valuation to estimate Pfizer's growth. Here, we're starting with an average of their last 3 years of cash flows, and then we're using historical assumptions to grow these into the future. Let's assume cash flows grow at 4% annually for the next decade. Then in the following decade, this will be cut in half, and we'll assume they only grow at 2% annually. If we're looking for a market-beating 15% rate of return, which is what Warren Buffett typically wants from his investments, then a DCF model says that today's valuations of fair value for Pfizer is around $28 per share, very close to their current stock price. Our third valuation uses future assumptions and whereas Pfizer has traded in their past to give us a fair value of $27 per share, also almost exactly at their current stock price. From their pandemic highs, Pfizer stock is down 54%. When we zoom out and look at the company long term, we can see that this isn't the first time that they've spiked and then underperformed the market for an extended period of time. That happened back in the late 90s during the dot-com bubble, and Pfizer proceeded to underperform the market well up until the global financial crisis. Now, we've covered the numbers that Warren Buffett likes, but it's the qualities of a company that are his true love. Let's learn what these are for Pfizer through a long and a short thesis before we combine them with the numbers at the end of the video. Starting with a long thesis first. Number 1, Pfizer's pipeline productivity is improving. They have several successful recent drug launches. In particular, cardiovascular drug Vyndaqel is a potential game changer in the rare disease arena. Number 2, Pfizer's strong success in developing a COVID-19 vaccine and treatment has yielded a massive cash windfall. These sales have dropped off significantly, but they've redeployed their profits. Number 3, Pfizer's decision to divest its off-patent division should result in a faster-growing, more innovative company. But it's not all positives. Let's look at a short thesis as well. Number 1, aggressive cost-cutting in research and development could hurt Pfizer's long-term prospects. This is especially given the importance of continued investment in innovation. Number 2, competition is increasing for Prevnar from Merck and Imbrands from Novartis. And number 3, the decline of COVID-19 products will create a drag on growth as the pandemic recedes. Now let's put everything together for Pfizer. In our fundamental review, we learned Pfizer goes 3 for 6 on the Select 6 analysis. The company's seen a major drop-off from their boom in COVID profits, and they've redeployed these through making major acquisitions in the last couple of years. Much of the company's future depends on these acquisitions working out, with over 50% of their market cap being deployed to this in just 4 years. Their big dividend yield is nice, but it's not supported by their cash flows today. The company has to return to historical profit levels, even though it's trading cheap just compared to where it was a couple of years ago. This is why when we look at a tool for Pfizer's fair value, today it comes in around $28 per share, just about their current stock price, which is $4 below their street target price. Pfizer seems to be around fairly valued, and you could reasonably expect average returns going forward. To follow Pfizer's valuation and find undervalued stocks, sign up for our investing tools and get exclusive bonus coverage of 97 stocks and counting.